All right, guys, we're going to go ahead and get started. We want to kind of respect everyone's time. I know there was a little bit of a hitch with the login, but it's about 5 minutes after, and we'd like to go ahead and proceed. So tonight we're going to be talking about unlocking homeownership, and let's go. Before we get started, I want to go ahead and introduce Mike, who's going to be your host today. He is the broker and owner of Bridgepoint Funding, and he has been since 2006. His experience actually goes back to about 3 decades. He's been the top 1% mortgage originator nationwide for many years. He's born and raised in the Bay Area. He's a huge Niners and Giants fan. He is Lita's husband for 25 years and counting, and he's a father to 6 and a grandfather to 11. So without further ado, Mike, I'll go ahead and turn it over to you.
All right, so thank you, everybody, for joining. Really, this afternoon's goal is to provide you with a clear understanding of the pre-approval process and why it is essential in your overall home buying journey. As a matter of fact, I would say that it is the most important step in the process. So let's go ahead and go to the next slide here. So one of the questions I get is, hey, Mike, what is a pre-approval? What can you explain what that is? So essentially, it's a review of your credit score, your income, and your assets, which will be used for your down payment and your closing costs. And then my team and I are going to review that to determine what your maximum purchasing power is. It's also very important to make sure that you do not confuse a pre-approval and a pre-qualification. They are not the same. They are actually quite different. A pre-approval is going to be based on verified and documented information. We're going to do a deep dive into your income, how you receive it, your assets, where they come from. Whereas a pre-qualification is essentially based on verbal information and or partial information. So one is more just a kind of a cursory review. We want to give you an idea. Pre-approval is a much more thorough review. So why getting pre-approved matters? It signals to sellers that you as a buyer are qualified, that you have taken proactive steps, and that you are ready to proceed when it comes time for you to make an offer. You're not just out there kicking tires. A pre-approval should provide you as a buyer clarity on your maximum pre-approval amount, your comfort level for your monthly payment, the required down payment, and the estimated amount that you will need for your closing costs. Now, I want to touch real quickly on the difference between your maximum pre-approval amount and your comfort level. So I've had many clients over the years, and they say, hey, Mike, great. It's good to know that I'm approved for 1.3 million, but the payment associated with that purchase price is too high. We would like a payment $500 or $1,000 lower. So that in turn might mean that we're going to lower the purchase price point to a million or 1.1 because of the difference between the comfort level that one is striving for versus the maximum. I do think it's really important to let you know as a buyer what your maximum is. That way, you know you'll have the ability to increase your offer if you're in a situation where the seller might be countering your offer. So they may want you to increase it by $10,000 or $15,000, and you are okay doing that. So it's really important to know in most cases what your maximum purchasing power is. All right, so what documents are necessary? What documents are needed? So this is not a comprehensive list, by the way, but this will suffice for 3 out of every 4 buyers, I would estimate. It's going to be the pay stubs that will cover the last 30-day period. So in most cases, that will be your last 2 pay stubs. Most employees these days are paid twice a month or every 2 weeks. W-2s covering the last 2 years. In many cases, actually in most cases, we only need the most recent year's pay stub, especially if you've been on the job longer than 2 years. If you've had multiple jobs over the last couple of years, we will need all of the W-2s in most situations. Year-ending pay stubs for the last couple of years. This is super helpful. if you have income such as overtime, bonus, and commission, because this income is not on virtually all or any W-2s, whereas it is on the year-ending pay stub. So we can calculate the overtime, bonus, or commission, and we can come up with a monthly income. Again, the W-2s don't allow us to do that. Your bank or brokerage statements for the last 2 months. That will be savings account. It could be mutual funds, stocks, whatever you're going to use for the transaction, and then also reserve. So even if you're not using the funds for the transaction, it is very helpful for us to have them. Let me give you an example. Let's say you say, hey, Mike, I have $200,000 allocated for this transaction, and you have a total of 300,000. It is very helpful for us to have the accounts and the document the entire 300,000, because it will strengthen your file, and it will oftentimes just help you have a stronger pre-approval. It doesn't mean we're going to use the funds, just means that it helps your file. Now, if you're self-employed, we will need tax returns for either the last 1 or 2 years. If you've been self-employed for 5 years, we generally only need the most recent year. If it's less than 5 years, we will typically need the 2 most recent tax years, both business and personal. If you do not have tax returns that have enough income on there, we do have a bank statement program. We have other programs as well, but the most common program when we're not using tax returns are bank statement program. We will look at the last 12 months bank statements, and we will calculate an income so that we can arrive at your pre-approval amount. And again, keep in mind, this is just a partial list depending on your particular situation. For instance, if you have multiple rental properties, we may need additional documents. If you have multiple businesses, we'll need additional documents. So this, for the most part, will 3 out of 4 home buyers will be able to proceed with the pre-approval. It's a great start. Okay, so credit. Credit is always a fun topic. It's something I talk about every day. And when we are looking at a pre-approval, of course, credit scores are important. I will say this. I talk to many, many clients who think that it's absolutely required to have excellent credit in order to purchase a home. That is, in fact, not the case. You don't need to have excellent credit. Does it help? Sure. Is there a path forward, for instance, if the credit is less than perfect? Absolutely there is. So we're going to look at the credit score. We're going to look at the debt that is on the credit report. And what we are looking at is not the balance, but we're looking at the minimum monthly payments. So if you have, for example, a credit card with a $10,000 balance and the monthly payment is $200, we're looking at that $200, not the $10,000 balance. We're also going to look at collections and charge-offs, bankruptcy, liens, judgments, anything that might be a negative on the credit report. And again, this does not mean that you cannot purchase a home. It just means that we're going to have to look at it. We're going to have to take a deep dive. We're going to have to get explanations, but oftentimes there still is a path forward. Okay, so income and employment. So I think most know that in order to purchase a home, especially an owner-occupied home, not necessarily a rental home, it is a requirement that you are employed. And I say that this is only for owner-occupied loans because there are programs for investment property purchases where you actually do not need employment as long as the property cash flows. So just wanted to mention that real quickly. In regard to an owner-occupied loan, we're looking for income. We're looking at the stability of the income. We're looking at the consistency of it and the sufficiency. Is there enough income? So the same thing for employment. We're looking at the history of the employment and we're looking at the stability. Do you have a stable job? For example, if you are working through a temp agency, I've had this happen in the past, and you might be working for 4 weeks and then you're not working for 2 weeks and then you're working for a week. that is not generally considered stable income. Oftentimes in the medical field, there are employees who are on call. If that particular employee has not been in that line of work for more than 2 years, that could be considered unstable income. So really knowing the story behind employment and why someone might be working on call or with a temp agency, we can put those pieces together and sometimes make it work. So if, by the way, someone has been on call or with a temp agency for more than 2 years, we can use that income, and in many cases, with as little as 1 year. So, excuse me, you'll see a little note here, education, and this is really important. Education is considered part of employment history. So if someone graduates from a trade school or with a degree and then goes into the workforce, we will use that education as part of the work history because we need a 2-year work history. Now, it's important to note that does not mean, don't confuse this to mean that you have to be on the job for 2 years. That's not the case. You can have 2 or 3 jobs in the last 2 years, or sometimes even more, and still qualify. So don't confuse a 2-year history with 2 years on the job. They are very different. Okay, so debt to income ratio is something that we look at when qualifying and determining the maximum purchasing power. And I just want to give you'll see here on the screen a quick example of what debt to income ratio. In this example, the buyer's debt to income ratio would be 46%. And it is, as you can see, there's a $4,000 housing payment. And that would be, by the way, inclusive of principal and interest, property taxes, insurance, HOA, everything as it relates to housing. In this example, we have a $500 car payment and then a $100 monthly payment towards credit cards. That adds up to $4,600, and we simply divide that by the gross monthly income. And in this example, we are assuming this buyer has an income of $10,000 per month. So that's just a quick explanation of how debt to income ratio works. So assets. Assets are what you will need for your down payment and closing costs and reserves if needed. I'm just going to touch on reserves because generally speaking, reserves will not be required. They are sometimes required for jumbo loans or if you have multiple properties, but for the vast majority of loans or bank statement loans for self-employed, we sometimes need reserves. But for FHA, conventional VA loans, oftentimes we don't need reserves. And definition of reserves is the funds left in your account after your down payment and closing costs. So let's say you have $100,000 in your account and you're putting $70,000 for the down payment, you need $10,000 for closing costs, you need $80,000 for the transaction. That $20,000 left over would be your reserves. So just so you understand what the definition of reserves is. Now, there are acceptable and non-acceptable sources of down payment. For instance, you can't use cash. You'll see on a non-acceptable source of funds. You can typically not use cash. I have a lot of clients who say, Mike, I've got cash, and sometimes this can be a large amount of cash. We can't source it. We can't show where it came from. Generally cannot use it. So what is acceptable? Your money that has been in your checking, savings, or investment accounts, Schwab, Merrill Lynch, Chase, Bank of America, checking, savings, mutual funds, money markets, CDs, as long as we can show that it's been seasoned, meaning it's been there for at least 2 months, then that is an acceptable source of down payment. In addition to that, retirement accounts such as 401k, 403b, or a thrift savings plan, those are all acceptable sources of down payment as well. And then gift funds. These typically will come from parents or grandparents, and those also are acceptable. So these are the most common sources of down payment. And by the way, you can you can use a little bit from each category. So you can use some from your savings, combine it with retirement, and then also receive gift funds in addition to that. All can be used for your down payment and closing costs. I touched on the non-acceptable source of down payment. Cash is very, very difficult. If it hasn't been in the account for 2+ months, we cannot use that in virtually every situation. And any monies that cannot be sourced or seasoned, sourced meaning we can't explain or show where it came from, seasoned meaning if it hasn't been there for at least 2 months. Closing costs, I've touched on this, and I'm gonna do a little bit of a deeper dive here. So closing costs generally range from 1.5% to 4%. Now, if you go on the internet and go down that rabbit hole, I know that because I did this, I wanted to see quite some time ago. There are a lot of different articles that say it's 2 to 6%. And that's probably true, but I can tell you it's very, very rare to have closing costs that exceed 4%. I actually had an employee of mine a couple years ago go over our last, I think it was 30 or 40 loans, and the closing cost averaged 2.6%. So normally speaking, your closing cost will be on the low end, 1.5%, on the high end, 4%. In rare, rare cases, they can be less or they can be more. They include title and escrow fees, prepaid items such as your insurance, which you're required to pay in advance for 1 year, prepaid interest, property related fees, appraisal report, which in most cases a buyer will need, and then any lender related costs, underwriting fee, processing fee, whatever that may be. So the good news is that sellers are allowed to provide a credit to cover buyers' closing costs in part or in full. So if you as a buyer are incurring $15,000 in closing costs, the seller in most cases will be allowed to provide a credit to cover that either in part or in full. That comes down to strategy. It comes down to competition. So if you're competing against even one additional buyer, you probably won't be able to negotiate a credit from the seller. But these last couple of years, we definitely have seen sellers credit for buyers' closing costs. Okay, these are the most common loan programs available. The conventional loan listed here at the top is the most used loan in the United States. And conventional loans can require as little as 3% down payment and a minimum credit score of 620. It's important to note those two, meaning a 3% down payment and a credit score as low as 620, don't go together. It's very, very difficult to get a final loan approval with a 3% and a 620 credit score. With a 620 credit score, you would likely need a higher down payment. With a 3% down payment, you would likely need a higher credit score, probably over 680 or maybe even over 700 in most cases. FHA loans require as little as 3.5% down. They are great loans. They've been around since 1934. There's a common misconception that they're only for first-time home buyers. They're not. They can be second, third, fourth-time buyers. They do have mortgage insurance, both a one-time upfront mortgage insurance and a monthly mortgage insurance, even if the down payment is 20% or greater. VA loans are for veterans and their qualified spouses, and they require no down payment as long as you don't already have another VA loan outstanding. VA does not have a loan limit. Bridgepoint Funding does. Our maximum loan amount is $5 million with no down payment. VA also allows credit scores down to 500, although those can be challenging loans to receive final loan approval on. And then lastly, jumbo loans. That's when the county loan limits are exceeded. Every year, new loan limits are announced, and each county has their maximum loan limit. So, for instance, Contra Costa County this year has a maximum loan limit of 1,209,000, and then Solano County, which is Benicia and Vallejo, is quite a bit lower. And so when the loan exceeds the county loan limits, it falls into a jumbo loan category with different lending guidelines. Okay, so we touched on a pre-approval. So let's talk about a TBD approval, or to be determined. And what this means is that the file has already been reviewed by the underwriter before you have even identified a property. Now, let me touch on what an underwriter is. An underwriter is the human being who reviews your entire file, your income, your assets, your credit, and ultimately determines whether your file will be approved. So it's a proactive step, and it really sets you up for success because sellers, at the recommendation of their real estate agent, are really looking for buyers who are proactive, who are prepared, and taking these steps to show that you are a serious buyer. And it really can create separation in many cases if, in fact, you have taken the steps to go through a TBD, to be determined. And we do this here at Bridgepoint Funding. We do it frequently, and we have a great success with it. It also will allow you as a buyer to shorten or waive your loan contingency. Again, that puts you in a much stronger position. You will have fewer hurdles once the offer has been accepted because the file has already been reviewed, and it will also lead to faster closings. All of this means that you are in a much better position, you're in a strong position, and you are taking these steps that many other buyers don't. So you're able to beat out the competition in many cases. Bottom line, it just puts you in a much better and stronger position. Okay, so what if you're not ready to buy right now? Well, every situation is unique. The most important thing is to have a plan. So it could be that you want to save up more money. It could be that you're waiting for gift funds that might come in 4 or 6 months. It could be that you are going to get a new job and you know that your income is going to increase significantly. I've had clients tell me they're going to get married and they are now going to have two incomes in the household. This really is dependent on every unique situation. And it just know that having a plan, having a path forward will really help you as you proceed in the forward on the pre-approval process. Okay, so what are some common myths about the pre-approval? Well, this is a big one. I hear this a lot. My credit score will drop once it's pulled. Well, the fact of the matter is, I don't think, and I've helped thousands of buyers, just to give some context here, I don't recall one single situation where it made a difference between someone being able to purchase or not. If the score drops, it will generally drop by 2 to 3 points and it will not have any impact. It's going to drop for the subsequent credit pull, by the way. So it's really necessary for a solid pre-approval. I would absolutely, I've bought many homes, so I have to pull my own credit when I do this. It is necessary to run credit to get you in a position to prepare you, and I would not worry about the score dropping. As a matter of fact, it will rebound in a very short period of time. There's too many other factors that ultimately impact the credit score: payment history, amount of debt that you have. Running credit is such a minor aspect of your total overall credit score. So another myth is I don't need a pre-approval until I find a home. Well, we just covered that in the previous slide. Getting pre-approved, having a TBD, waiting until you find a home is a very reactive approach. I've had many clients who've done that. They've come to me, said, hey, I want to get pre-approved. Offers are, tomorrow at 9 a.m. or tomorrow at 12 a.m. And they just don't have the time to collect all the documents, send them in, and they miss out on an opportunity. So being proactive is very, very important. Pre-approval guarantees my loan. That is absolutely not the case. A pre-approval will set you up for success. Excuse me. But if something changes after the pre-approval, excuse me, I'm going to take a drink here. A pre-approval, again, does not guarantee final loan approval. Let me just kind of state the obvious. When we pre-approve someone, it's going to be based on the income, meaning that the buyer who we pre-approved has employment. Well, if they lose a job a week later after the pre-approval is no longer valid. So it's important to know things can change. You don't want to go buy a car. I think we're going to talk about this on one of the next slides. But it will definitely put you in a much, much better position, but guarantee is too strong of a statement. And I've heard people say this, so that's why I wanted to point it out. So let's go ahead and we're going to move to the next slide here. Okay, so congratulations, your pre-approval is complete. So now what? I mean, what does that mean? Well, what it means is that a pre-approval letter will be issued. And I really want you to think of a pre-approval as a ticket. You now have a ticket, an admission ticket to go shopping. You are a serious buyer. You can present an offer to the seller, and that seller should know that not only do you have the desire, but you have the ability to purchase that home. You're not just kicking tires. You're not wondering if you can purchase a home. You absolutely are in a position to make an offer and ultimately close on the home and get the keys to your new home. So you also want to work with a trusted real estate agent. We at Bridgepoint Funding work with a lot of agents of various areas throughout the Bay Area. If you need a referral, please let us know. We're more than happy to make that connection. And then also, there's a question that I get. How long is a pre-approval good for? So again, if you go on the internet and you talk to many of my colleagues and lenders and loan officers out there, the standard industry answer is 90 days. Well, I would say 90 days, but be careful. That does not mean, and I've actually had clients say this to me, oh, I'm pre-approved. Essentially, I can go buy a car, I can go do whatever I want. No, you cannot. You have to make sure that you keep everything in order, that nothing essentially changes. So if your income changes and you take a job where you are earning less, or you go from full-time to part-time after the pre-approval, or if you have overtime and you now, over the course of the next 2 or 3 months, don't work any overtime, your income will be decreased, and this could impact your pre-approval. So it's really important to know that if there's going to be any changes, I think we're going to, if we can go to the next slide here. So and this is really the word of caution, is that check with your mortgage team if any of these, or if you have any, if you're wondering, if something tells you, you know what, I'm not quite sure if I can do this. But here's just 6 real quick things. Obtaining new debt. So if you're going to buy a new car or a boat or a timeshare, pause, stop, give us a call, give your mortgage advisor a call and say, can I do this? Okay. You don't want to just go out and do it. You don't want to co-sign for somebody. For the most common would be for a car. Oftentimes, parents will co-sign for their kids for a car. If you've been pre-approved, you don't want to do that. If you are thinking about buying a home, again, you want to research it. You want to check out to see if it's going to negatively impact your ability to get pre-approved for your desired amount. Quitting or changing jobs. Now, we're not necessarily going to penalize you. I tell people, I'm not going to penalize you for taking a better job, for getting a pay increase, but communication is so critically important, right? What if you go from a 40-hour job to a 32-hour job? So just know communication is critical. Make it any large purchases. We kind of talked about that, a car, a boat, an RV. Those would fall into the category of what most would be considered large purchases. Or, by the way, co-signing for someone on a piece of property. Okay, that's another one that you want to really be very, very careful of doing and make sure you have a conversation. Moving money around, anytime you do this, you transfer from, say, a checking to a savings or from one bank to another bank, it does have to be documented. So just be aware that if you're going to move it, you will be asked for the bank statement where you move the money from. It's always a good idea to have a conversation before moving any of your funds around. And then large deposits. Large deposits could be cash. It could be a sale of a piece of jewelry. That's a personal item. Let's say you sold a very expensive piece of jewelry and you got five, 10, $15,000. That's going to be difficult to use because you can't really source or explain where that came from. So we would really not um, be able to truly know that it was a piece of jewelry. Now, if you happen to be able to show that you purchased that piece of jewelry, you've got all the documentation, and then you sell it, then yes, we could. I can tell you that typically doesn't happen. The only time I've had that happen is as it relates to cars. So if we can show that you purchased a car, you own the car, you had a pink slip, and now you're selling it, that we can use those funds for your down payment or closing costs. So just be aware, communicate, and make sure that you don't go out and do anything that may put your pre-approval in jeopardy. Okay, so what's next? Well, if you are looking to get pre-approved, you want to book your initial consultation, and you can do that by scanning the QR code. You can call the office. You can go to our website and book an appointment. There's multiple ways to contact my team and I so that we can set you up for the next step. So if you have any questions regarding that, just reach out, email, text, whatever you'd like. So. If you have any questions, please go ahead and you can I think put them in the chat there, and then I'll be more than happy to answer them for you. Um,
If it's also easier for you, you can feel free to unmute yourself and ask the question too.
you could do if you put in the chat, or you can whatever you prefer. Or if you prefer, you can send an email directly to me, and I will make sure and respond. So we'll just give it a few more seconds here to see if anybody has any questions. And my email is right there on the screen. You can snap a picture of that if you don't already have it. And in my signature line, by the way, in my email address, you will have the ability to book an appointment. Or on my website, there's ability to book an appointment as well there.
All right, I'm not seeing any
Okay.
questions in the
All
chat,
right.
Mike.
All right. Well, hopefully this was helpful. And again, any questions, feel free to reach out. Thank you very much. And we will be having another webinar next month, and we will be notifying everyone about that as well. So have a great evening. Thank you, everyone.
Good night.
Yeah.